Hi, welcome to MyWealth.com. I'm Mike Conlon. I'm one of the senior instructors with the courses. Welcome to today's blog. Today we're talking about yesterday's FOMC meeting. Okay, and the blog's entitled Market Tells Bernanke, Take a Hike. Alright, so when are low rates not a good thing? Okay, well, when you're Ben Bernanke and you've just finished up an FOMC meeting, that's one. Alright, much has been made of the inflation versus deflation debate. In fact, our own Bob O'Brien wrote a great article about it this past week, talking about whether we're in for inflationary or deflationary times. All right, but at the end of the day, neither of those, whether we're in inflation or deflation, is going to matter much if the market has no confidence in our economy or the guys who are supposedly in charge of it. All right, when the Fed announced yesterday on Wednesday that it would be keeping interest rates unchanged and that they were going to stay the course with their asset repurchase program, it came as no surprise to anyone. Okay, and yet the market sold off immediately. Okay, now the market almost always overreacts to FOMC announcement day quite dramatically. Okay, but I don't think the reaction was the one that Ben was looking for. All right, from the Fed release, they said basically the prices of energy and other commodities have risen of late. However, substantial resource slack is likely to dampen cost pressures, and the committee expects that inflation will remain subdued for some time. All right, so under normal circumstances and under credible conditions, okay, a statement like this would be a slam dunk for the market. Okay, stocks would go flying. Okay, but yet we sold off. So let's take a look at what real traders know about what's going on in the market and what Bernanke is trying to get you to disbelieve.
As always, be sure to check out the written blog at www.mywealth.com/blog. Okay, one of the first things that we need to look at and talk about when we're talking about the markets, okay, is that the markets hate uncertainty. All right, in the Fed statement, the Fed did not mention an exit strategy for how and when they plan on removing this huge monetary stimulus plan they've got going on now. All right, you've probably heard a lot about this recently. The Fed's got quantitative easing going on, and they're trying to buy back toxic assets. Okay, this tells the market that perhaps we're not out of the economic woods yet, as others in government may have you believe. Okay, you hear a lot of talk about how the economy's turning around, things are starting to bottom. Okay, this may not be the case. All right, the fact that there was no mention of a exit strategy means one of two things. Okay, the first thing it means is that it's definitely going to be a very long time before the stimulus can be removed. And the second thing is that these guys might not even have a plan at all for how they're going to remove the stimulus. All right, so this is very worrying to the markets. And when there is worrying out there in the marketplace, things tend to sell off. Okay, the second thing that happens when there's uncertainty is that you get a flight to safety. All right, because of this uncertainty, we saw a move back into the U.S. dollars yesterday in what we call the flight to safety trade. Okay, basically what happens is people sell their non-U.S. dollar denominated assets, okay, and they move back into the U.S. dollar. So they're getting out of the speculative currencies, maybe things like the Australian dollar, which does well when commodity prices are doing well, and they come back to the U.S. dollar. Okay, so this move did not happen because investors are seeing strength in the U.S. economy. Okay, but it's rather the exact opposite, that they're seeing weakness. And as we know, weakness in the U.S. economy is going to translate over into weakness in the global economy. Okay, the next thing that's happened is these green shoots have vanished. Where'd they go? It wasn't too long ago we were talking about, all the recovery that's taking place in the economy, and there was some speculation going into this meeting that inflation was beginning to happen, that the economy had bottomed and things were starting to turn around. All right, if this were the case, traders would have expected Ben to mention this recovery and would have probably expected him to put forth some sort of mention of an exit strategy that we talked about earlier. Okay, one of the exit strategies people are talking about is possible rate hike. All right. Now, he didn't make any mention of a rate hike in the future. Now, usually what happens with a rate hike is they do that to stop inflation and if the economy is beginning to heat up too much. Okay, because they've taken such extraordinary measures, interest rates are very low right now. So even a rate hike of the smallest proportions would move us right back to what would be a normal level. Okay, but Bernanke made no mention of it the other day. So that's also leading people to believe that the economy may not be turning around like people think. Okay, next is that Bernanke said that inflation is tame. Well, sort of. He actually did mention that commodity and energy prices have gone up recently, but he's saying that their future outlook for inflation is tame. Well, I mean, I guess if you compare oil prices to their highs of $147 about a year ago, then oil at $68 doesn't seem that inflationary. But then again, if you compare the price of oil to earlier this year when it was in the high 30s, then in fact it does seem inflationary. So which is it, Ben? All right, the fact that he didn't actually quantify this statement has led to more uncertainty as well. Okay, if we had an idea of where he thought oil prices should be, what would be inflationary, then people could sort of make a judgment as to how we're going to be able to determine when we're in an inflationary or deflationary environment. All right, so don't wait. Get educated, get in a course, come to www.mywealth.com, check out our currency and investing courses to learn how you can learn to see what's going on with the government and how this affects your investments.
It's really pretty simple. The markets can handle a bit of inflation. Markets can also handle a bit of deflation. Okay, but what the markets can't handle is the uncertainty of how the Fed views each condition and how it's going to react. Okay, while market participants are known for being impatient, this may have been the one time when giving a little would have meant a lot. Okay, if you want the markets to be stronger, then you have to project strength and not weakness. Okay, I'm not sure that Ben has gotten it quite yet, as he sticks to his just the facts ma'am approach. Alright, but let's just hope that this doesn't have the opposite effect and that the markets go tanking. Alright, so to learn more about how Fed decisions can affect your investments, be sure to check out our currency and our investing courses at www.mywealth.com. I'm Mike Conlon. Thanks for being with me, and I hope to see you in the courses.